Your Own CFO, Part 15, an overview of revenue. Revenue is basically the proceeds that you generate from conducting your normal business activities. The basic calculation is simple enough. It's the total number of units sold multiplied by the price per unit. In most scenarios, that's fairly straightforward. However, it can get a lot more interesting. We won't go very deep on the principles of revenue recognition, but I'll give you a few examples to illustrate the point. Let's say you're an e-commerce business. In most cases, your revenue is simply the sales number that you see on Shopify. But there are some common e-commerce mistakes when it comes to revenue. Let's say you sell a gift card. That doesn't become revenue until you've fulfilled the obligation associated with that gift card. Let's say you sell a 6-month subscription to a product. You only earn the revenue as each month's goods are shipped out, even if you were paid up front. Let's say you do a pre-sale for a new product launch. That's not revenue until you actually ship the goods out. Or let's say you're an agency that does media buying. You can record the revenue each month as you bill it to the client. But let's say you're a web design agency and you take on a 6-month project. It doesn't matter how you bill a client. You record revenue as a function of how you're completing the project. For the most part, these might sound like nuanced details, and they kind of are, but it can matter for better interpreting your financial performance or reporting it to others, or even for tax purposes. Next, we'll talk about the recommended way to track your revenue.